What if the biggest financial warning of 2026 never appeared on the front page? No market crash. No emergency press conference. No breaking news alert. Yet behind the scenes, something extraordinary happened. Within just a few days, banks rushed to borrow more than $100 billion from the Federal Reserve standing repo facility, the largest surge since the financial turmoil of 2020. Banks don't use this facility because it's cheap or convenient. They reveal a much bigger story about the health of America's financial system, a story that could shape interest rates, mortgages, and even your personal finances over the next several years. Let's pull back the curtain. Segment 1, the hidden engine of the economy. Most people believe the economy runs on consumers, businesses, and the stock market. But those are only the visible pieces. Hidden underneath is a giant financial network where trillions of dollars move between banks, investment firms, money market funds, and governments every single day. This invisible system supplies the liquidity that keeps the entire economy functioning. Think of it like the plumbing inside a skyscraper. Nobody admires the pipes when everything works. People only notice them after water suddenly stops flowing. The financial system operates the same way. As long as banks can easily borrow and lend money to one another, nobody pays attention. But the moment liquidity becomes scarce, stress spreads faster than most people imagine. That's exactly why the Federal Reserve created the standing repo facility. If a bank suddenly needs cash, it temporarily exchanges U.S. Treasury securities with the Federal Reserve in return for overnight funding. Segment 2, how years of tightening created today's problem. To understand why this happened, we need to go back several years. After inflation reached its highest level in decades, the Federal Reserve launched one of the most aggressive tightening campaigns in modern history. Most people focused on higher interest rates. But another powerful tool was working quietly in the background. Instead of injecting money into financial markets like it had done during the pandemic, the Fed began shrinking its own balance sheet through quantitative tightening. Every month, billions of dollars in liquidity slowly disappeared from the banking system. At first, almost nobody noticed. Banks still held enormous reserves built up during years of stimulus. Cash remained plentiful. Markets stayed calm. By late 2025, reserve balances had fallen to their lowest levels in years. Short-term funding markets started showing subtle signs of stress. Borrowing costs edged higher. Segment 3, when history starts rhyming. This wasn't the first time the financial system sent out a quiet warning. Back in September 2019, something strange happened. There was no recession, no banking collapse, no global crisis. Yet overnight, the cost of borrowing cash suddenly exploded. Repo rates jumped from around 2% to nearly 10% in just a few hours, catching Wall Street completely off guard. The problem wasn't a lack of assets. It was a lack of available cash. Banks became reluctant to lend, liquidity vanished almost instantly, and a normally invisible corner of the financial system turned into the center of attention. The Federal Reserve had to step in with billions of dollars in emergency funding just to restore stability. That episode taught policymakers an important lesson. Financial stress doesn't always begin with collapsing stock prices or failing banks. Sometimes it starts quietly, deep inside funding markets where almost nobody is looking. Segment 4, the number that changed everything. Then came the figure that grabbed Wall Street's attention. More than $100 billion flowed through the Federal Reserve standing repo facility in an incredibly short period of time. That wasn't a routine fluctuation. It was one of the largest borrowing surges recorded since the extraordinary market stress of 2020. The amount itself was significant, but the speed made it even more remarkable. Banks didn't gradually increase their borrowing over several weeks. Demand spiked almost overnight. That tells us something important. When institutions suddenly seek emergency liquidity at the same time, it usually means they're becoming more cautious about lending to one another. Not because they're failing, but because uncertainty is increasing. In finance, confidence is everything. The moment confidence begins to fade, banks naturally protect themselves. They hold on to cash. They reduce risk. Segment 5, the Fed's quiet reversal. Here's the part that received far less attention than the borrowing itself. Just as banks were tapping the standing repo facility at record levels, the Federal Reserve made a quiet but significant policy shift. Officials announced that quantitative tightening, the program responsible for steadily draining liquidity from the financial system would come to an end. There were no dramatic headlines, no emergency press conference, no declaration that something had gone wrong. Instead, the decision appeared inside a routine policy statement, written in the careful language central banks often use when they want to avoid creating unnecessary panic. But markets understood exactly what it meant. For nearly 4 years, the Fed had been pulling liquidity out of the banking system to fight inflation. Now, it was signaling that enough was enough. The priority was no longer removing cash. It's a reminder that monetary policy isn't just about inflation. Segment 6. Why this matters to you. It's easy to hear terms like repo market or bank reserves and assume they only matter to economists and Wall Street traders. In reality, they affect almost everyone. The repo market sits at the foundation of the financial system. When liquidity flows smoothly, banks can lend confidently, businesses can borrow to expand, and consumers generally have easier access to mortgages, car loans, and credit. But when liquidity becomes tighter, those effects don't stay inside the banking system. They spread, banks become more cautious, businesses delay investment, borrowing becomes more expensive, credit standards tighten, hiring slows. None of these changes happen overnight. They develop gradually, often months after the first signs of stress appear in funding markets. That's why professional investors pay so much attention to these early indicators. It wasn't simply about banks needing cash. Segment 7. What happens next? So, where does the story go from here? The truth is, nobody knows exactly how the next chapter will unfold. But there are a few signals that deserve close attention. The first is the standing repo facility itself. If borrowing quickly falls back to normal levels, this episode may simply reflect temporary pressure inside funding markets. But if banks continue relying on the facility week after week, it would suggest that liquidity remains tighter than policymakers would like. The second signal is the level of bank reserves. The Federal Reserve has made it clear that it wants reserves to stay ample, but markets will be watching closely to see whether they actually remain there. If reserves begin shrinking again, the same pressures could eventually return. The third signal is short-term funding rates. These markets often react long before stocks, housing, or the broader economy. That's what makes this moment so important. The biggest financial stories rarely begin with panic. They begin with quiet decisions, subtle market movements, and numbers that most people never notice. The record use of the standing repo facility wasn't just another statistic. It revealed growing pressure beneath the surface of the financial system. And the Federal Reserve's decision to end quantitative tightening wasn't a coincidence. The markets that shape your mortgage, your investments, your savings, and the broader economy don't wait for headlines. They move first. The headlines simply catch up later. And that's why understanding what's happening beneath the surface isn't just useful, it's one of the biggest advantages any investor can have.